All right. Well, I am going to take a moment to just let Bill Wright speak because his hand is up. Bill, you have about 10 seconds. How are you doing this evening?
Doing fine.
Okay.
All right, we'll go ahead and get underway. Welcome, everybody, to the September 2017 edition of the Roundtable. My name is Mark Robertson. I am joined here by my good friends Ken Kavula of the Mid-Michigan, basically all of Michigan, and nationally recognized educator and presenter, and my friend from Atlanta, Cy Lynch, also very well known for some of his presentations at the national conventions and the work he's done around the countryside. Hugh McManus had intended to join us tonight, but once again, we're struck with the travel and business bug with Hugh, and he was not going to be getting back in time to be able to support the event tonight. And again, my name is Mark. I'm managing partner of Manifest Investing, and I'm just glad to be here. Glad you guys are all here with us also. We're going to cover some fairly interesting stuff here tonight, I think. The picture that I chose for the cover slide tonight does show some pretty incredible changing of the colors. That's actually a shot from Tequanimon Falls up in northern Michigan. Really nice waterfall, nice place to visit just north of Mackinac City. And but the subject of autumn is going to come up when we start talking about delving into this subject of quality and what it might, how we might be able to use some of the disciplines and philosophy we've put together, our interpretations, to perhaps protect us a little bit better and perhaps give us another fairly concrete thing to think about when it comes to selling stocks. Other than that, we'll do our traditional program, and again, everybody just have some fun, and we're here to share some ideas. Let's get the legal paperwork out of the way here for a minute. This is all about education. No investment recommendation whatsoever is intended. This is about education. It's also about taking the philosophies, strategies, methods, techniques, anything you can think of that are associated with the modern investment club movement and put into practice by NAIC, Better Investing, and the advocates of long-term investing at places like Manifest Investing. They are our viewpoints. We may hold some of these stocks, and we'll try to mention them. I definitely hold shares of the one that I'm bringing tonight. So does other members of our family, but we will try to keep that in mind as we go. But again, the most important thing is don't run out and act on anything you hear. This is just a nudge to do your own homework. Here's basically our standing agenda every month. Again, we want to welcome everyone, and in fact, an extra big welcome if you're joining us for the first time. We do keep this fairly casual. As you can see down at the bottom, as we finish our prepared remarks, we do open the floor up for either a microphone, audio questions and answers, or we also can, and others will be monitoring the questions tab, so you can actually type in or text in input there. We do keep track of our results. We'll take a look at our progress year to date. We're coming up again on almost 8 years of doing this. There are a few companies on the hot seat tonight. We'll take a look at those, including ConocoPhillips, which was just mentioned in the green room, Michael Kors, Waste Connections, which is one that we can really celebrate, Under Armour, which continues to annoy many of us, including me. The four stocks that you see are there. That's Alliance Data Systems from Psy, ADS. Ken is going to bring Schwab, SCHW. I'm actually going to tame down the wildness that I've had the last couple of months with Zoe's Kitchen and come back with CVS Health. And Hugh is going to be stubborn and, again, highlight GE as a undervalued opportunity. Even if you're joining us for the first time, you're welcome to vote in the audience poll. We'll put those four up there along with none of the above when we get there. And again, the floor is open at the end to talk about the stuff we talk about here tonight, or if you have other investing related questions that you'd like to explore. Here's just a quick reminder of what we're doing. We've been doing this now for over 7 years. We come together either the regular nights of the round table. We do have guest damsels and guest nights also. And we're sharing what we feel are interesting or favorite investment opportunities that merit further study and digging in. We do take this seriously. We keep track, and we also want to achieve a portfolio that beats the market by 5 percentage points. That's what we mean by a long-term relative return of 5%. We measure the general stock market by the Wilshire 5000 index fund. And we would like to see the majority of our selections actually outperform the market, or outperform a matching investment into the index. And we'll like to see that happen a majority of the time. Here's a quick look at our results. What you see on your screen here is, again, 7 years of operation. Those are month-by-month results. The y-axis is the relative return, and quite simply, it's just a measurement of how well the portfolio, the tracking portfolio that we keep track of, the rate of return has done versus the Wilshire 5000. Anything above 0 would mean that our selections collectively are beating the market. Anything below 0 would be underperforming the market. So you can see that the trend has actually been fairly healthy. We are running at approximately a 3 percentage point outperformance to the total stock market. The actual absolute rate of return right now is right at 13%, and a little over half of our selections have outperformed the market. That dotted line that you see across there at 5 is what is generally regarded by many of us to be the kind of the global objective of all investment clubs, and that is to attempt to target and try to beat the market by 5 percentage points. And again, over the very long term, with a very long-term perspective, when George Nicholson, the grandfather of the modern investment club movement, was talking about this subject, he basically was saying, well, if the market goes up 10% over the very long term, I think we can beat that by 5 percentage points and achieve 15%-ish type returns over the long term. So that's what that red line represents, just of that target or that objective of trying to beat the market by 5 percentage points. Any comments or questions before we press on, Ken?
No, everything looks good right now, Mark.
All right. So let's go ahead and see what has built that performance. What you're looking at on your screen is an excerpt or an extract of the roundtable tracking portfolio. What we do every single time we make a decision, whether it's a knight or a damsel or even an audience vote, we invest $1,000 into the idea. In the case of Cognizant Technology at the top, you can see that there is now $22,000, 160 of value, and that has actually been selected 12 times. So 12 times down here with this legend, 12 times invested into Cognizant Technology, $12,000 is now $22,000. So you can use the legend that is imposed down at the bottom to see how many multiple selections have been made of some of those stocks on the list. Now, these are the top 20 in terms of percent of total assets, or the top 20 positions that have the most influence on the portfolio. There's about 80 or 90 total positions. You can actually look at all of the positions using that public link up at the top of the page, manifestinvesting.com/dashboards/public/round-table. There's some really interesting things there on the list. You can see I'm going to bring CVS here tonight, so that'll actually be the 10th time that we've selected CVS. So far, our $9,000 invested in CVS are worth a little over $10,000. So I'm hopeful for nothing but blue skies ahead on that one. Any of these come out and reach either of the two of you? What grab you?
I'm really interested in that Mesa Labs holding, Mark. That's the sixth one on the list, I think. 1, 2, 3, 4, 5, 6. And that one's only been chosen 6 times. So we're getting 12,000 plus out of 6,000 invested in Mesa Labs, the kind of small company that if you can find in the early parts of its development and then ride it for a long time as it goes through explosive growth, you have the possibility of really doing quite well with it. That happens to be a stock that my wife and I own, and we've owned it for a long while, and we're extremely happy with what's going on with it. We've owned Mesa Labs since it traded at about $35 or $40 a share, and at 140 something today, we're very pleased with what's going on.
How about you, Si? Anything on the list grab you?
The one I would just mention, C.H. Robinson, about a third of the way up from the bottom, CHRW, for a couple of reasons. First of all, notice $6,700. I think it's a 5-time pick, so it's hasn't done anything like Mesa Labs, but it has gained a bit. I'm not sure how it has done relative to the market. But it is one of those that certainly needed patience because it has had some down times, but is coming up, and I think even on a relative basis, it's pretty good. But notice that the projected return going forward is just 5.8, which is not an awful return in this market, just a little below the market, and not a whole lot of growth. So I pointed out, first of all, as an example of the importance of patience, to C.H. Robinson has come back, but then also just point out that may be one also that we want to take a look at in future months and consider whether or not it might be worth taking some money and running.
And it'll probably show up on the hot seat at some point. Well, I'm kind of surprised that the one right next to Mesa Labs got by, Ken, because it's one that I also want to point out. You guys all know this is the time of year when we take a look at small companies. Well, Universal Display, ticker symbol OLED. This one gives me goosebumps because if you notice down here, it's a 3-time selection. It's a 3-time selection that is now worth $14,000. And you can actually go back and listen to our remarks on this one in the YouTube archives. Ken and I selected it independently, but on the same night, and the audience actually voted for it too. So we had thought about doing one-hit wonders tonight. Well, this would have been a one-hit wonder that received 3 votes or $3,000 on one night. It's never been repeated, and it's now up to $14,000. So that one's pretty cool. But this is the time of year. If you spot an intriguing, compelling, smaller, faster growing company, please, as you did last year, bring it to our attention, and we find some interesting things when we go shopping together.
Mark, we have a hand in the air from George, so I'm going to unmute George. George, go ahead. What's on your mind? Maybe George has an inadvertent hand in the air. George, are you there? Okay, I'm going to take George's hand down. How about George? I have another George with his hand in the air. This one's George. Is it George? Is it Mackey? No, that's an inadvertent hand. How about George Tufel? Okay, I'm going to take those hands down, and we'll unmute, or we'll mute back up everybody and keep going, Mark, all right?
Okay, let's go ahead and press on. You can see the overall portfolio. Just a real quick thing to comment about. The average stock right now is trading at about, or has a return forecast of about 7%. So with the overall portfolio at 9.9, roughly 10%, that's not the end of the world, but we'd sure like to see that number boosted, either by dispensing with some companies with low return forecasts and just continuing to bring companies with strong return forecasts to keep that number strong. Quality is fine at 83.7. Again, we'd like to see that above 80, somewhere in the 80 to 90 range in general. And the overall growth rate of the portfolio right now is, again, about 9.9, about 10%. And again, that's pretty good. We'd like to see that in the 10 or 11% range. And again, you get there with companies like Universal Display and Mesa Labs, finding those promising, faster growing, smaller companies. We want to make sure we're always on the vanguard and being vigilant about watching for those type of opportunities. All right, so let's go ahead and talk about some companies that may be on the hot seat tonight. When Ken does the presentation on this, he refers to what Nicholson referred to as Rule 1, and that's simply the notion of switching from a stock with weaker expectations into one with higher expectations. So what we do is we take the roundtable tracking portfolio dashboard and sort it from lowest return forecast and concentrate on the companies at the low end of that spectrum. In the case of ConocoPhillips, Waste Connections, Oceaneering, Caterpillar to some extent, and Michael Kors, you see that they're low single-digit returns. So we'll take a closer look at some of these. Now, Waste Connections is down there because it's gone up so much. That's a one-time Ken Kavula selection, so $1,000 invested is now worth almost $2,600. So that they can get there for the right reason, and that is a stock price that has actually taken off. So we'll take a look at Conoco and Waste Connections and see what we can see. Conoco's a tough one. This is one of Hugh's special situations, less conventional picks, and the company's been completely retooled here in recent years. You can pretty much disregard, at least for the purposes of trend formation, anything before, I would say, 2015. The company is divested divisions, the PSX spinoff, all that kind of stuff. So you're left with a completely reconfigured company over the last couple of years and going forward into the future. So it's kind of a tough call. This is a pretty good sized company at $28 billion in revenues, but the expectations are kind of all over the map. The reconfigured company, you can find analyst expectations ranging from low single digits to low double digits on this company. And even with an expectation of a 9% return and something resembling some of the highest net margins they've had in their history, which is possible. I mean, Value Line has the company at a 3 to 5 year forecast of a 15.8% net margin. They've not ever come close to that, but they could. But if, again, delivering fairly conventional but still high margins with the PE ratios associated with it's fairly deep cyclical, it's kind of hard to generate anything of great interest. You can see the holes in the profitability here, times when they actually generated negative earnings. So there's a lot of missing PEs, all that sort of stuff. So I'm kind of the mindset to recommend that we go ahead and walk away from it, even though we're showing about a 4% here on the audited version of the thing, because we also have BP. So I'm not so sure we need to have both, but with this one on the hot seat. Any questions or comments on that? This perhaps George Wright has, or it was Bill Wright that may have some commentary he could add to this also. You still there, Ken?
I'm here, but I'm muted. Now I'm not. I would tend to agree that it might be the time to walk away from this one and to walk away from Waste Connections with a tidy a positive in its return. So I'm looking at I'm trying to do two things at once right here. John wants to know ConocoPhillips. Is ConocoPhillips into gas or oil? And doesn't ConocoPhillips kind of name itself as an overall kind of general producer? Is that right? Or am I just way off base on that, Mark?
Oh, it's definitely an integrated producer. I cannot specifically call out the percentages of both, but they are very globally diversified. Cy, do you have any comment on Conoco?
No, I don't. I was trying to call up a little bit, although, as you said, it is totally restructured since 2015-16. I remember looking at the old Phillips Petroleum probably 10 years or so ago after a big presentation, and I was trying to remember exactly what that was, but I don't know anything more recent on ConocoPhillips.
Yeah, and unless we give the wrong impression, this one is actually, it hasn't quite kept up with the market, but it's not a loser. It's actually generated about a 20% overall return with all the positions, so it hasn't been a loser. But again, we're looking at the positions within the context of the overall portfolio. And
right.
Mark, we're getting some comments from Peter Phillip, who lives in Tulsa, right in the heart of the oil patch down there, and he says Conoco is mainly in the exploration of oil, so they're oil-based, and he says they're selling their business with the highest operating expenses, and I would assume that means he's comparing to companies like ExxonMobil and some of the other large integrated companies. They're trying to drop their operating expenses down to $35 per barrel, which would give them some room for some profit. If they can do that, then I'll coordinate that. Peter says not tried to, but they actually did that. They dropped their expenses to $35 a barrel, so they've provided themselves with some room to negotiate this minefield of oil prices. I'll pair that with a discussion I heard this morning on one of the news shows being done with 4 or 5 gentlemen highly placed in the oil industry, that we're talking about Saudi Arabia and the fact that right now Saudi Arabia is doing everything it can to prop up the price of oil, and they're doing that by trying to keep OPEC attuned to production quotas and even production cuts in some cases. And these folks from the United States oil industry seem to feel that movement by Saudi Arabia would continue until the Aramco company went public. Saudi is going to take its oil industry public in the next year sometime, and they feel that they're kind of setting the stage. They're trying to do everything right and hit all the right notes. I don't know, some of you might have heard that they announced they were going to allow women to drive. They were the last country in the world that had restrictions against women driving, and in the next 6 months they're going to now allow women to drive. And the oil gentlemen felt that all those things were tied together with trying to hit all the right notes and to make people feel nice and warm about Saudi Arabia as this Aramco company comes to the market, comes to the publicly traded market. And that will happen in less than a year now, if their dates are correct that they talked about this morning. So all that stuff, maybe this $50 plus oil is going to be fairly fleeting. They seem to think that oil's natural price was somewhere down around $40 a barrel. So I'll leave it at that, and I'm just giving you information secondhand that I heard from a bunch of people that are supposed to know what they're talking about. So.
Well, Hugh is notorious for pointing out that how far it could drop, and we didn't believe him at the time, but he's got some fairly long-term perspectives when it comes to oil pricing, and he doesn't think it's heading right back up, but he does think it will be restored ultimately. All right, so I think we'll go ahead and dump that one. On Waste Connections, I think it's time to high five and just run around the water cooler. This is another one that has had a fairly significant acquisition added to it, so that's the step change on the right-hand side, but this one's a winner all around for us. It's just gotten perhaps a little bit ahead of itself.
This is one that my investment club moved out of about 9 or 10 months ago with a healthy profit as well.
Yeah.
So, it's a great company. There's not much not to like about it, but we did feel it was getting a little bit ahead of itself.
Yeah, and it's even up almost $6 in the last month, so that's a pretty nice little run. All right, and here's my moment of another mea culpa. I don't know how many times I have to buy and suffer through Under Armour, but this is that rule of 5 trigger that we have talked about so often here. This is the only one that qualifies for tonight's discussion, but for the audience that's not familiar with it, we have actually been exploring and are attempting to demonstrate this notion of when we pick a stock, no matter how solid or wonderful the idea is or how complete the study is, if it falls 20% behind the market, we're basically employing the notion of calling a timeout or giving it a timeout, much like my grandchildren. And in this case, this one's behaving just like the 2-year-old. The stock price has taken another dive down, and it is actually more than 20% behind the Wilshire 5000 now. We picked this up back in January of this year, and the size of that arrow on the far right over here is actually 20%. So you can see it's actually sagged down. So I think we have to take our automatic timeout. And for those of you like me that are fans of Under Armour, we have to wait for our opportunity to perhaps watch this thing bottom out. That's a subject we're going to talk about in greater details too about watching for quality ratings that are bottoming out. And that takes us right into this discussion that we've been having. Ken, I'm going to turn it over to you. Just this notion of, we have known all along, one of the second things we talk about when we talk about when it's time to sell a stock is if there's quality deterioration or degradation. And we're going to attempt to take some of the tools that are in front of us at Manifest Investing. We built our quality ratings, as you can see on that figure on the lower left, just to give everybody a quick refresher. It's a very unemotional thing. It's almost robotic, where we took a look at the financial strength, the earnings stability, the straightness of the earnings trend on the stock selection guide, and then the growth and profitability comparisons to peers and competitors, and we give it a score and rank them. You're going to hear about that from Cy also. The recipe or the formula is covered in that article on the right. Quality measured, excellence ranked. And again, if you want to read more about the subject of quality at Manifest Investing, you can Google it, but use the word excellence in place of quality. And Ken has been chewing on this out, so I'll let Ken describe exactly the type of concept we're taking a look at for putting that whole discipline and philosophy to work.
Well, at our brand new program called Turnout Tuesday, earlier this month, Mark and I presented a class that we had presented at Bank, and it was a class that was aiming to tie first-year performance, to tie it to relative return, and then to set some triggers that would get us out of a stock when the relative return compared to the market as a whole and compared to the company's industry, when the market return was really substandard. We like to think of that as the rule of five, that just as Mark has just said, whenever you do some studies, one of them is it's going to outperform at the top level. But one of the 5 studies that you do is going to underperform, and there's not going to necessarily be specific rhymes and reasons for it to happen. So that's the trigger that we're using here on Under Armour. But the thing that I've been exploring now, and I've been going through our large tracking portfolio, looking at these chronicle pictures, because I'd like to find out if there has been any indicator that we can see that will keep some of our capital preservation and not put us in a position where the stock just moves down towards zero. Fossil is an excellent example. And Mark took the chronicle and made a picture of it here and then circled the place that interests me an awful lot. That's a 10%, that's a 10-point or better drop in quality. And it happened over a relatively small period of time, 2 or 3 months. These green bars, there's 1 green bar per month, and this is about a 4-year table. What's interesting, however, on this stock, and then I'm going to back it up with a few more examples, what's interesting is that if I would have decided that the quality no longer suits my tastes, that I was looking at a very high quality stock when I purchased this stock, and with this huge drop in quality, it's no longer the kind of stock that I want in my portfolio. If I were to look at it right when that quality is degraded, and then if I were to look into the future 3 or 4 months, think 3 or 4 or 5 of the green bars, and notice that the price didn't really do too much for at least 3 months right there, and especially when you compare the price of the stock right after the quality degradation to where it is today. Notice that the stock has taken a couple of other smaller drops down in quality, and then about 6 or 7 months ago, it took another huge drop in quality, down to a place where it's definitely not a stock that I would even consider anymore. Notice the price bars at that point. If I were to hover, if this were a live chronicle in the Manifest website, I could hover over those green bars and I could actually read the price off of each green bar. I'm just kind of estimating based on the scale on the right there, but I think Fossil right now is probably trading somewhere in the $253, $350 dollar range. If I would have sold my stake in Fossil, I wouldn't be preserving all of my capital, but I would have sold it probably somewhere in the $11, $10, $9 range, and that's a pretty significant savings to me, preserving of my own capital to reinvest in other places. So when I saw that happening, then I started to go through the database stock by stock. So I got to Echo Global Logistics. It's a stock very similar to C.H.R. Robinson or the stock out of Washington State with the Expeditors International, thank you. But they do logistics for trucking companies, and some of the companies are moving into logistics for air freight as well. But my point is, when you see a big quality degradation, you have some time after that degrading of quality to still sell that stock before it starts to really move down. Look at the green bar on your far right there, where you can see the stock maybe trading at, I don't know, $13, $14 a share, and go back to that circle degrading of quality when the stock was trading up around $30 a share, and when it continued to trade in that roughly same range for a 6 or 7 month period. You had some time to consider, you had some time to think, and at that point, getting rid of it at that degradation, or getting rid of it at the degradation that occurred only 5 or 6 months ago, you still had 2 or 3 months to think about it after that quality declined before the price followed suit, before everybody discovered that it wasn't as high a quality company as they had maybe thought it was. I think I might be onto something, and our slide says 10 percentile points in a quarter, but I'm looking basically at just a 10-point drop, not 10 percentile points. Percentile, yes,
Yeah,
that is correct. Okay, that is correct, yeah. Here's another example. This is Michael Kors, and there's been a number of quality degradations, but each time the quality drops, notice you've had a period of time to sell that stock at a reasonable price. And even though the quality's been in constant disarray in basically a downward trend for 2, maybe 3 years, this is the one example of where it didn't hurt you as much as it might have hurt you in the other two. I haven't gotten through the entire database yet. I don't know if this is a rule that we're going to want to attach. Mark and I did a lot of talking on our way to a club meeting today about the possibility of setting some triggers that would alert us to a quality drop over a 2 or a 3 month period of 10 percentile points or more. And if we could get those kind of alerts, we feel pretty confident that the list of companies in the database that meet those criteria are pretty small. That would give us a short list to compare against almost any portfolio that we held, and maybe draw to our attention the fact that the company is having some issues that are affecting directly how it competes with its peers and competitors. They're affecting directly how the world views its financial strength, and there might be some real issues with earnings stability. So this is just the beginning of a study, just the beginning of trying to come up with yet another trigger. It would be our second one, and when we started this whole experiment about a year ago, Mark and I both said we would like to see a trigger that would help us preserve capital and then also help us preserve capital gains. So we're looking at a couple of different triggers. We've instituted the one that triggers a sale when we're more than 20% in relative return beneath the market and beneath the industry that the company happens to be in. And now here's another one. Perhaps a 10 percentile drop over a 2 or 3 month period, perhaps that's enough to trigger at least a hard look at the stock, if not an outright, let's get rid of this one, because it's not where we thought it was when we bought it. It's not the company that we bought.
Yeah, and this one's kind of fascinating to me, Ken, also because you've got this is another more than 10 percentage point drop over here on the right-hand side, in addition to breaking through that 80 threshold for quality. So it's actually gone from being an excellent company to a good company. But it'll be very interesting to see if that is a sign of weakening conditions. The other thing that I notice is even with the stock price going down over the last year, that you can see with these green price bars, the return forecast has actually continued down. There's only one way for that to happen. That's if the fundamentals are degrading or weakening. So I think this is one we pull out again next month, and this is maybe an example of a potential sell just on the basis of this quality inflection or tipping point. Cy,
Yeah,
any thoughts?
just go on, Cy. Yeah.
Yeah, I was going to say one thing, just looking, and I'm wondering, Michael Kors, although I've never really followed it, I know a little bit about the company from a distance, and Fossil may be an example as well, at least on those early degradation, is that what you may be seeing happen, and it may be one reason why there is some lag, is that you have a company that isn't necessarily turning into a bad or even a mediocre company. You may have a company that has a very high quality rating and has been priced it by the market, given a premium pricing by the market because it's a high growth company. And as it matures, it hits that tipping point from the high growth into the more mature company. So it's not turning into a bad company, but what you have occurring is the quality dips down because now the relative growth in particular tips, possibly relative profitability. And when that occurs, guess what also goes down? The PE ratio.
Yep, exactly.
And so you're getting the double whammy, but of course it takes a little bit of time for the market to digest it in the PE ratio.
Mm-hmm.
So that so anyway, I'm kind of fascinated by that, and I can see that it might certainly have some promise, and I think it's we need to be careful also in looking at it, in using words like degradation and so forth, that it's not necessarily the company turning into a bad, or like I say, even mediocre company. It's just turning from a superstar, maybe overpriced hero, into a more normal, mature company.
Interesting.
At least some of the early ones. Now, when you keep
use the word declining, rather than degradation. Yeah.
Exactly.
For those of you in the audience that are looking for a couple of more examples, I would suggest that if you're really interested in this, you might look at ASPS. That's Alta Source Portfolio Solutions, which is in the a roundtable portfolio. You might also look at OII, which is Oilfield International, and you might also look at Hibbett Sporting Goods, HIBB. Those are three more examples that I've come across where you get this decline in quality, and then you have a 2, 3, 4, even 5 or 6 month period sometimes to decide whether you're going to exit the position before you see the price really take off and move towards zero. I like to remind myself constantly that I used to ask the question, how low can it go? And for some of these companies, you need to remind yourself that sometimes it can approach zero. Companies can go out of business, and I think that we might be in the process of seeing something like that happening with Fossil right now.
Sure.
That, Fossil's become a fashion statement. A traditional analog watch is now a fashion statement for the younger generation. It has nothing to do with telling time anymore. It's a bracelet more than anything else.
All right, well, speaking of time, we probably need to move on and step lively through our stock presentations, but I'll just close by saying we will be doing some mapping and some case studies where we look specifically at price, weakness versus quality, and try to come up with some type of a guideline or a very simple and easy to use rule that might allow us to take advantage of what seems to be a potential early warning signal. And we'll be bringing back more information on this pretty soon on this one, guys. So let's go ahead and switch to the stocks presentations, and Cy's going to kick us off with Alliance Data Systems. I was stunned that that's not already in the roundtable portfolio, because I know it's an Eddie Elfenbein favorite. So go ahead and take it away, Cy. I can see up straight and parallel already here. So,
Right. All right. I will do it. And I think it is interesting that it's not in the portfolio because it's been appearing in some of your screens, and I think you may mention it later on. And I've been noticing it. I know I've mentioned it in our group. I don't remember if I mentioned to the audience as a whole that I've been looking at it for a couple of months, but so finally decided we would go with it. Alliance Data, as you can see, up straight and parallel. We'll talk a little bit more about the company, but basically, if you're not familiar with them, they are a marketing, advertising, customer tracking company that is actually very much of a private label credit card issuer. The reason I didn't bring it 2 or 3 months ago was when I discovered that about 75% of its revenues were from credit card both processing and issuing. I wanted to try and evaluate it as a financial company, and I really haven't had a chance to do that and decided to take the plunge with just a regular, more conventional analysis, which I think for some reasons fits Alliance okay anyhow. Next slide. I came up with Alliance by doing what I usually do, ranking the tracking portfolio by par and just taking a look to see if anything jumps out at me as something interesting. Of course, EPAM, one of my recent repeat picks, is still reasonably attractive, but I didn't want to be accused of being stubborn like Hugh, since he's gone, was done. So I chose not to do that. CVS is their price line. I think I've picked both of those, and of course we've various other nights have picked them as well, and those are good solid companies that are right there. And actually, I was surprised to see GE there. So kudos a bit to Hugh, but I noticed that GE there as well. And I kind of came down to Starbucks. Notice it's just a 2-time pick. So that was a potential. And so I said, let's see if there is something that matches the potential return on Starbucks of good quality out there that may be more interesting than repeating Starbucks. So next slide. So I did a stock search with the 14% par. I went ahead, rather than setting it quite as strict a quality as Starbucks had, I just used my standard 80 quality ranking for excellence and an 80 financial strength just for screening purposes. And here is what popped up. You see a fair number of holdings in the tracking portfolio in this list, and they're in the second highest par is Alliance Data with outstanding quality of 93% and good numbers the rest of the way across. And I was also attracted by the 14.8% growth rate since the portfolio could use a little bit of boosting on the growth. So I said, this looks interesting. Let's take a look at it. Quick industry study. You can see that it's right up there in its industry information services on quality. And it is, I didn't give you the actual ranking, but you can kind of guess from this screen, it is the highest par in the industry. So it's certainly a leader in its industry on both par right now for value and quality. So next slide. Here's where I will briefly tell you a little bit more about the company for time purposes, and just the fact of the matter, quite honestly, the company is a little bit of a complex company if you try and dig in deep, but it's something you can understand what they do. They operate in 3 segments. As you can see, store branded credit cards, which is the credit services. Essentially a company, one of their recent partners is Williams-Sonoma. Williams-Sonoma wants to issue credit cards. They come to Alliance Data. Alliance Data will issue the credit card and service the credit card and also harvest data. That's one reason why companies, retailers like to have private label cards. It's accepted only at their store, so it ties the customer somewhat to them, but also it allows them to track purchases. Then they also run customer loyalty programs. Think frequent flyer miles, frequent renter programs for hotels, frequent buyer programs in the retail industry. That's their second segment. That's about 15% or so of their revenues. And then they take the data generated by those two divisions, the credit cards and the loyalty programs, and they have an analytics and electronic marketing division where they take that. It used to be essentially you would buy, let's say someone at Michael Kors buys a purse, and so they would then send out an email suggesting some accessory similar to the purse or along the same product line. That's really kind of a passe way of advertising digitally now. Everything is being driven in apps and display ads on apps and websites, and Alliance Data is trying to crack into that. That, of course, is really the niche right now of Facebook, Amazon, those companies, and Alliance Data is trying to work into there. Next slide. What's interesting about Alliance Data, and I'll just toss it out there, if you take a look at it, you will see, is that if you compare Morningstar and Value Line, not only will you see, you may say, gee, I see judgments all over the place, which really, if you dig deeper, the judgments are somewhat similar, but what you see is the raw data is all over the place. Alliance Data Systems, their GAAP numbers, that's generally accepted accounting principle numbers, are not what management follows. They have a lot, because they've done a lot of acquisition and growth through acquisition, a lot of their GAAP numbers are impacted by amortizing intangibles. And Value Line and the company track what they call core earnings, which are actually about double the GAAP earnings. So the PE ratios and everything are quite different between Morningstar, which uses GAAP numbers, and Value Line and the company that use non-GAAP figures. So it's just kind of interesting when you see that and you start wondering why profit margins and everything are all over the place. But that's one of the advantages of using sales and not getting hung up on EPS as your projection tool, because you can cut through all of that. Here's just the default manifest numbers: sales growth of just under 15%, net margin of 12. Actually, I circled the EPS. That should be the PE of 14, which gives you a 19% projected return. Next slide. I walk through my stock selection guide, which is using the Morningstar numbers. I don't usually do this, but here I just wanted to show how completely different analysis using somewhat different take on the numbers comes to a very similar conclusion. I used an 11% return. That is roughly the last couple of years and 2 quarters growth. There is concern with Alliance Data that, of course, retailing is being taken over by a gorilla named Amazon. Alliance Data tends to believe Amazon's not going to be the only retailer in the world and that they've still got room to grow, but that's concern, and certainly their growth may slow down. So I used 11%, which is somewhat lower than the default manifest, but seems sustainable. Next slide. Here's the manifest quality rating on Alliance Data. Again, very high quality ranking, which that's the percentile ranking of this calculated 74. The 74 ranked with all of manifest covered companies comes out in the 93 percentile, which is very high. And notice all of the financial strength, stability, and growth are all over 20 in the ranking, in the scoring category, which is well above average. Their net profit margin is just slightly below the industry average. But again, a very solid quality company to take a look at. Next slide. Then here, and this is where I really discovered the difference, was trying to track PEs. My PE will end up being somewhat higher than the manifest PE, but I'm using a lower earnings per share figure than the manifest figure. So actually, if you adjust for that, the PEs come out somewhat closer, although I'm maybe a little under. I mean, a little under actually. High PE of 30, the low for an average of about 24, which I think compares to the manifest of about 14. But again, as I say, they're actually calculated on different earnings per share, so they're not as disparate as they appear. And I came up with a potential high price of 514, which is a little below both the value line and the manifest high price. Next slide. And end up with a 14.4% potential return based on an average PE going forward. A fascinating company, and I think an area that more and more retailers in particular are turning to these customer loyalty programs to allow them to track what customers buy and focus their marketing to their best customers, and that's what Alliance Data seeks to do. So,
you're good. Thanks, Si. We'll go ahead and add it to the pile. While Ken's warming up here, I just wanted to take a moment and point out that Si will be joining our Turnout broadcast on October 10th, and we're using 100 different titles for this, but it's basically a discussion of risk, defining it and understanding it better, and we look forward to putting that session out there and talking about how most of the investing world really doesn't understand risk and defines it badly, and maybe our community can take advantage of that from time to time. So we'll invite you to join us for that session. So let's go ahead and have Ken take us away with Charles Schwab, I think a stranger to very few people here.
Okay, do you have my first slide inserted here, Mark?
Boom.
There we go. Okay. I got a letter about 8 or 10 months ago informing me that my broker, my primary broker, which was Scottrade, is being acquired by Ameritrade, TD Ameritrade. And I started to kind of keep an eye open and discovered that there was a huge amount of consolidation going on in the brokerage industry, and there was a lot of fighting going on as to who was going to be able to attract the most customers and who was going to be able to lower their prices the most to keep those customers happy. I think that we're in a historic place right now with the consolidation in this industry. And I really feel that if you are looking and interested in the brokerage industry, that you might be able to pinpoint 1 or 2 survivors, and they might be extremely profitable for the next 4, 5, 6, 7 years, and perhaps beyond if they come to dominate the industry. Schwab, for example, has had its strongest first half of new accounts in the last 17 years. They've had 7 consecutive months of over 100,000 new accounts, and the households new to Schwab as part of their Schwab retail business rose 50%. That is phenomenal growth no matter how you want to parse it and no matter how you want to qualify it. It's phenomenal growth. Next slide, Mark. And as this growth has been occurring, they've also noticed that the percentage of cash in the accounts that they're holding at Schwab has declined from 13% cash in December of 2016 to 11.5% cash. That doesn't seem overly dramatic, 1.5 points, until you ask yourself how much money do they actually have under management, how much money is included in their accounts. They're coming very close to $250 billion. So 1.5% of those funds the cash in those accounts moving into the market can be significant. Notice that as the S&P goes up, the percent of cash in the accounts has tended to move in the other direction. Next slide, please. This Schwab site, where I got a lot of these slides from, loves to use acronyms, and you have to really scoot around and find out what the acronyms stand for. That TOA in this particular slide stands for transfer of accounts. So the number of accounts transferred from another broker into Schwab has gone up 25%, half year over half year. First half of fiscal 17 compared to first half of fiscal 16. The money flowing in has increased 86% in this transfer of accounts. And when you compare the transfer of accounts dollars to their competitors, they're beating their competitors by 110% in this particular metric. And this is one that all the brokers tend to keep a real close eye on. It talks about new business, and it talks about holding on to the business they have. Next slide again. This is a little bit busy, and the words are a little bit small, but if you get a chance to come back to this slide, you'll notice that all of the things that we normally look at to gauge a company are really growing, and they're growing pretty quickly. I will tell you that the one place where Schwab has had decreases is in the amount of money generated in commissions from selling stock. They met Fidelity's drop in commission prices, and they're extremely competitive with Fidelity right now. Fidelity and Schwab are forcing the rest of the brokerage industry to match their commissions, and even the deep commission brokers that were already at $6 or $7 have seen fit to lower their commission prices to stay less than Fidelity and Schwab and some of the other larger players. So the metrics are pretty positive, except for that one metric that talks about money earned from commissions. Next slide, please, Mark. Schwab, I was impressed also. I went to the Fidelity site, and I went to look at Raymond James, and I went to look at Edward Jones, and I could see nothing in their presentations where they were addressing how they're going to comply with the Department of Labor's fiduciary rule. Now, the rule isn't even set. There's no guarantee that the rule is finally going to be implemented in the same fashion that it's being talked about right now, but the general thrust of the rule is to require more responsibility on the part of brokerage houses to act as fiduciaries for their clients, which means they have to act in their clients' best financial interests. Schwab has been very proactive in this field. They've taken the rule the way it stands right now, and they feel they're ready to meet the guidelines of the rule the way it stands, and they feel they're positioned really well to adjust what they're going to do no matter where the Department of Labor takes this rule and where it happens to end up. Like I said, very proactive. The other companies might be doing something in this area, but they're not talking about it very much, or at least I couldn't find very much on this when I looked at some of the direct competitors to Schwab. Next slide, Mark. I like this one a lot because it reminds me of my stock selection guide. It's talking about a little bit different things. That darker blue line at the top right now is the revenues, and the lighter blue line in that top graph is the expenses. And as the distance between those two lines gets larger, then the profits get larger. And you can see that they're doing a nice job of driving expenses down and trying to keep revenues relatively consistent, maybe raising them just a little bit. I'm very impressed with the pre-tax profit margins coming from this company. Back in 2004, down under 20%, and today up over 40%. Schwab has committed itself to taking all interest increases coming from the Federal Reserve and driving that percentage directly to the bottom line. They feel that when the Federal Reserve raises interest by a quarter point, that quarter point should drive directly to pre-tax profit margins, because it essentially doesn't change their business model at all, and that comes through as just profit if the company is operating lean and mean, which is the way that Schwab likes to characterize itself. Next slide, please. Here's an eagle from Manifest Investing, and the eagle on Schwab is done using book value because this is an asset-based company. And using the growth in book value, using some numbers from the analysts, we're looking at a growth number of about 14%. That's the base number, so I then went to my own SSG. Next slide, Mark. Here's the lines that we're used to seeing. If I were to turn book value on this graph, you would see that it's really mimicking quite closely the blue line, the earnings line. They could be, one could be a proxy for the other in this particular company's case. So I just chose to stick with the traditional green line and blue line. Next slide, if you would, Mark. I grew sales at about 14% and earnings at about 15%. Those are well within the estimates made by a lot of the analysts going forward, and a lot of the standard sources that I use and that I read. Next slide, please. And when I finished my SSG, I came out with Schwab as a buy, and I'm ending up with a number at about 13%. You know, that's close enough to the manifest number for me to have a lot of confidence. My SSG is validated. I'm verifying that I'm thinking along the same lines as the analyst community as far as numbers are concerned. And I think 13% return in today's market with a very high quality stock is a pretty decent thing to find. I like the up, straight, and parallel nature of the graph that we saw a couple slides ago, so I'm adding $1,000 in Schwab to the tracking portfolio.
Yeah, thanks, Ken. It's good to have a couple of new names in the tracking portfolio, Alliance Data and Schwab. All right, I'm going to go ahead and wrap us up here fairly quickly. This is our third and final presentation. I'll try to wrap it up here in a couple of minutes so we can go on to the vote and take care of any questions. But I did want to share with everybody that I think I have a new favorite stock screen. Many of you know that I have this screen called the Ivory Soap screen, where I try to search for the top percentile of stocks ranking with the best return forecast and the best quality ratings, and basically look for the top 0.5% of everything out there. So we still like to do that, but I want to borrow some of Hugh McManus's magic, because for those of you that don't know, he does have the best track record here amongst the Knights of the Round Table, and we're all aspiring to be like Hugh when we grow up. But he likes to shop down around the 52-week low price. This is consistent with people like Walter Schloss and a number of value-type investors, and for that matter, Ken Janke is an example at NAIC Better Investing would like to point out that the annual range is wider than you think it is for most companies, and it's a good idea to shop when they're closer to their 52-week low than their 52-week high in most cases. The screening tool at Manifest actually only looks and makes a relative comparison between the current price and the 52-week low, but what Hugh actually does is he zones. It's a one-year zone, not a 5-year zoning, but a one-year situation where the low side of the zone is the 52-week low, but the upside is the 52-week target based on our own assumptions for growth, profitability, and PEs. And Hugh likes to search when it's down in this range. So let's take a look and see what type of companies pop up right now. Again, this is a combination of good long-term return forecasts, very good quality in most cases, and so those two conditions being present, and then looking for the ones that are in the best position towards that 52-week low. And you can see over here on the right, again, Hugh generally likes to shop when that number gets less than 20, so it's approaching the 52-week low. But you can see that he's actually going to double down on or triple down on General Electric here tonight. But there's a number of companies there that are worthy of study. Notice that Alliance Data is on there. Ulta Beauty is one that has come up. Open Text is kind of an interesting study. And then CVS Health is one that I'm going to go ahead and latch onto tonight. Here's a dashboard built from the 10 qualifiers with the best, again, best double down situation of good long-term outlook and good short-term outlook or position. And just rolling down the dashboard again, Ulta Beauty, Alliance Data, Cirrus could be interesting. I looked at Open Text. It's a company not dramatically different than Infosys and some of the other information companies that we have in the portfolio, including Cognizant, by the way. So there's one for you to study, OTEX, OTEX. But again, I just wanted a little more conventional pick this month and went with a company that everybody here knows well, CVS Health. Many of us hold shares of the company in our portfolios. Definitely up straight and parallel. The biggest news on CVS Health is they've lost a couple of contracts within the last 6 months or so, and that has put a bit of a dent in both revenues and profitability. Nothing major, nothing life-threatening, but enough to put a bit of a dent and scare a few investors and certainly traders off. And that's kind of some of the sluggishness in the activity that we've been seeing. When you take a look at CVS over the long term, any way you slice it, you're looking at a longer term growth trend of about 8%. So I'd be very comfortable with a number anywhere near 8% in a study of CVS Health. As far as the profitability goes, they're in the same business basically as Walgreens, no matter what anybody out there would like to believe. I realize they're all playing with their business models and doing tweaking, but what it comes down to is these guys are a combination pharmacy and retail operation along with some other healthcare consulting. But at the end of the day, these are companies that are ranging in that 3 to 4% net margin bracket. At one time, there was some hope that CVS might actually lap Walgreens and go a little bit higher than that, but with maturity and everything else, along with those results that you're seeing there in 2017 and expectations for 2018, we're talking about a company with a margin between 3 and 4, so call it 3.5, 3.5, 3.6, 3.7. That would all be good. How about the PE? The PE, again, reflects a very mature company that probably belongs somewhere in the low to mid-teens. So you see the annual look, much like a stock selection guide on the top there, ranging in that 14, 15, 16 range. And then the PE ranges from a 12 or 13-year look on a month-by-month basis at big charts. Again, suggesting that a number somewhere in that 15, 16, 17 neighborhood would not be difficult to believe. So here's just a quick summary of the assumptions made. The value line assumptions from earlier this month lead to a long-term low total return forecast of 13 and a projected return closer to 20. We have seen the price jump up a couple of dollars, even with a slightly more conservative sales growth forecast, down a couple percentage points from value line, but sticking with the same projected net margin of 3.7. A few more shares still outstanding, PE in the same range. We're looking at a return, again, in the mid-teens, low to mid-teens. That's a real nice place to be for a very established company with a very high quality rating and pretty good situation. Again, with the average stock at 6 or 7%, I like a company coming in at matching the growth rate of the overall portfolio, so we're doing okay there for a mature company. And pretty nice return compared to the average stock right now. So we'll go ahead and accumulate our 10th position in CVS Health. And here's just a quick look at the forecast. The return forecast is up near highs. There's a little bit of a little ditch in quality at the end there. And just a real quick look at the sluggishness over the last year or so. Again, that's more related to just wrinkles in the business and the challenges of operating a business. The one thing that I know, though, is that we like to feel better, we like to live longer, and all that stuff is true, and Americans consume quite a few of those things on the right. So we'll go ahead and add that to the portfolio. he was going to just double down on General Electric. Again, no major story here. He's just being stubborn, noticing that it's trading near its 52-week low, so he wanted to throw that on the pile. It is a company that has dramatically changed. They have shed assets. So anytime you're doing an analysis of General Electric, you can pretty much disregard the left-hand side and focus on the restructured company and the expectations for the company going forward. With pretty decent looking return, much like Cy had noticed earlier in his screening results. So with that, I think, Ken, we can go ahead with the poll and wrap up business here tonight.
Okay, if you'll give me just a moment to get that poll ready to go.
And I did want to point out that... go ahead.
Go on, finish before I launch it, Mark, yeah?
Well, I was just going to say that the high position of Alliance data in my screens and all that shouldn't affect how people vote for my company, right?
All right.
I think
Here we
it
go.
should be
Is that awkward or what?
double.
Here we go with the poll, and I'd like to see about 85% of the audience voting. We just crossed 60%. All you have to do is use your mouse and pick a vote. It's a little bit more difficult if you're on a different platform, but we're down to 83%. I'm going to give it about 6 more seconds. 86% have voted, 87% have voted, 88%, and I'm going to close the poll at 90% voting. So let's close the poll and let's share the results. And looks like we're going to add 2 positions in Charles Schwab tonight. Very close race with Alliance Data Systems this evening.
Yeah, I think all 4 of them are pretty well positioned. We'll see how the rule of 5 treats us all.
Okay. I'm going to hide this poll, Mark, and I think that do you have coming events up on the screen next? Is that what?
We get control. Yeah, here
Okay.
we go.
Like to remind you about this Tuesday turnout. That's another program jointly sponsored by Mid-Michigan and Manifest. If you have not gotten a link to Tuesday turnout, if you are receiving links to the roundtable, then Natalie, my wife, is including a second link to Turnout Tuesday in that same email, and you will get a reminder when this comes a little bit closer on maybe sometime 1st or 2nd of October. I'll be speaking at the Rocky Mountain chapter in Denver, Colorado on October 14th. You can go to the Denver Rocky Mountain website to find more information. Mark is going to be in Wichita, Kansas on October 19th, and Mark and I together are going to be in Dallas on October 21st. So again, if you're looking for information about where these events are being held, the Wichita visit, you might want to contact Mark directly. He's still setting up some logistics on that one. The Dallas visit, the details are available on the Dallas chapter website, on the Better Investing website. Our next roundtable is October 24th, and then Mark and I are traveling to Pekin, Illinois, which is just south of Peoria in the Heart of Illinois chapter, the Central Illinois area, and we'll be there on November 4th for a full day program. So we have lots of things coming up. Our next Turnout Tuesday after October 10th will be sometime in the beginning of November, and we will be sure to keep you up to date on when that will be happening and what the content will be of that particular program. Mark, if you want to close the recording off, and then we can see if we can get a few of these questions answered. We don't have a whole